Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm excited for you to join me today. We do this show live every Tuesday to help you learn the ins and outs of passive real estate so you can go into your next deal with confidence. And so if you haven't done so already, make sure to check out PassiveInvestingWithWhitney.com. There, I have some free goodies for you. Also, you can snag some time on my calendar. We can talk about your passive real estate investing goals and how we can help you here at PassiveInvesting.com, and you can get access to our opportunities. Now, make sure to check out PassiveInvestingWithWhitney.com. Now, today we are going to talk about reducing sequence of risk or sequence of return risk with passive note investments, specifically note fund investments. But before we launch into today's topic, if we haven't had the opportunity to meet already, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here. And this is the whole reason why I invest in real estate, in equity deals, and in debt deals, is so I can actually spend more time, have freedom of choice on how I spend my time, and spend it with these, my crazy crew here. We do a lot of traveling, a lot of outdoor exploration, mountain biking, climbing, paddleboarding. The summer is our heyday. We absolutely love it. But this is the whole reason why I have learned to become a master in passive investing, private equity real estate. But it didn't start off like that. I started off like many of you, as an accidental landlord. I bought a house with a significant other and the relationship fell apart. And about a month later, I had a house and I didn't know what to do with it. Eventually rehabbed that house, stuffed it full of a bunch of roommates so I could cash flow the property. And really, I didn't even understand what cash flow was. I just didn't want to have to pay the bills. I didn't want to have to be on the hook for all the bills. And 11 months later, I sold the property. But that really kicked off back in 2002, my real estate investing bug, because from there, I was able to understand how to unhook my time, my value that I create in the world from how much time I trade for it. And so did several more what we call live and flips and house hacks on my own, and then with my husband pictured here. And then we decided that, hey, if we want cash flow, if we want to actually replicate our income, we need to start holding on to some of these properties and putting renters into them. And so we scaled up about 36 single family rental units and then stacked on top of it a 52-unit apartment building. And that's when we came to the realization we got to go bigger, faster, but do we do it actively or passively? And here's the thing, we did both, okay? Or I did both, I should say. But really, it's the passive investments, our portfolio here, that continues to grow, day over day, month over month. And this is what allowed us to have this result, which is 100% control and choice on how we spend our time. Now, I'm still work. I love working, but I get to do what I love. I get to wake up and spend my time here with you, with investors, helping you understand not only your investment goals, risk, and timeline, but also how passive real estate can help you achieve those goals. And at the same time, mitigate that risk and understand how to invest in moderate that timeline. And I get to help you do that here at PassiveInvesting.com. We're going to be talking specifically about our note fund investing today. We're going to do a lot of education before then. But, we have very strong metrics here at PassiveInvesting.com, whether it's our 308 million plus deployed through our rehab wallet lending arm, or the 1.4 billion that we hold in our equity portfolio, and our strong returns to our investors. Now, we are going to be talking about sequence of return risk here today. So there is going to be some math, all right? But whatever we talk about today is not financial advice, legal advice, or tax advice. So take all this information back to your investment team before making any investment decision. All right, guys. So let's talk about what sequence of return risk is. Now, for a lot of people, they hear this term and it just kind of like their eyes glaze over. They're like, I don't even know what you're talking about. Well, let's start here. So what sequences or sequence of return risks, they're the same thing, is it refers to the order in which an investment returns occur. And if there's risk involved, how that will negatively impact the overall value of the total portfolio. Particularly, this is particularly where most people paid attention to it is in retirement, especially during the withdrawal phase. But I actually argue every single investor, no matter what your age is, you need to be planning for and understanding how to mitigate and reduce your sequence risk throughout your entire portfolio hold. Okay. Now, this risk can actually stem from the timing of returns. Okay. When do you start getting the returns in your portfolio? The withdrawal during your retirement phase or withdrawal period. Maybe you're withdrawing from your portfolio to buy a car for yourself, replace a vehicle, buy a vehicle for your kid, pay for college tuition, pay for a wedding. Okay, maybe withdraw from your portfolio for a down payment on property. Okay, these all impact your portfolio. So it's glaringly apparent during retirement that every investor that's here should be paying attention to sequence risks throughout their entire portfolio hold. All right. Then we got our large unplanned withdrawals. Okay. Now we can plan when we need to buy a car, when weddings happen, stuff like that. We can actually plan a little bit here, but sometimes maybe you have a weather event and you need to replace a roof on your property or replace a water heater or something like that, and you need to withdraw from your portfolio. Okay, those are unplanned withdrawals. Maybe there's a large medical expense. Okay, and then we also have the sequence risk that's introduced in our portfolio just by market volatility. Now, if the last 24 months has been any indication to investors, that sequence of return risk is very apparent. For investors that's been in real estate 5, 10, 15 years, the market volatility of the past 2 years has been impactful, but not as impactful for somebody who's just getting started investing in real estate. And the important thing is to understand that sequence or return risk is crucial to being able to plan effectively. Now, especially during retirement, but it emphasizes the importance of not just the average return, but the order in which returns occur relative to the withdrawals of the portfolio. Now, if that just kind of like sailed over your head, don't worry. I'm going to have a graphic here in a second that'll help drive this home. But I want you to understand here, while we're talking about sequence of return risks, some of which you can plan for, some of which you can't plan for, there are ways to mitigate on both sides. Really why you have to plan for this, again, is to optimize your returns during retirement. When you are retiring, you don't have that paycheck coming in. So you have to rely upon what your portfolio is putting out. Planning for sequence or return risk actually will help you hedge market volatility. All right. It'll help protect your portfolio in the long run and prevent it from being depleted. And it'll help ensure sustainable withdrawals so you can maintain your lifestyle. Okay. Like if you need to make a withdrawal that's planned or unplanned. But most importantly, learning how to mitigate sequence risk throughout your entire portfolio hold will just help reduce stress and anxiety. Okay. So here's the problem. Let's get down to the nuts and bolts of this. Okay, I took this graphic from an article on LinkedIn because I just thought it was very plain and simple, showing you how sequence of return risk can actually impact the portfolio. Okay, the problem is risk is particularly significant for retirees. Okay, that's often where we usually talk about it, but this risk can come in at any point in time. The reason why it's significant for retirees is generally they're only withdrawing from their portfolio and not actually adding back to their portfolio through contributions. Okay. So the reason why a lot of fiduciary advisors don't talk about sequence risk whenever you're 30, 40, or maybe even in your early 50s is because they think that you are going to be able to make up that gap by able to continually contribute to your portfolio. And that may be true. But let's assume that we can mitigate this throughout our entire hold. Okay. Now, here in this example, we've got our investor here who starts off in retirement. Okay, so 0 year is when the year that they're retiring. So they're no longer earning earned income into their portfolio. So they're not really contributing to it. They're letting their portfolio be able to sustain them for their remaining years during retirement. Now, they have a return, a 6% loss in that first year. They're continuing to pay catch up. Okay, they just are like completely behind the 8 ball every year as they continue to withdraw from their portfolio. Now, if they don't experience any sort of loss, okay, early on in their portfolios, just a smooth 6% return, okay, they will be, they should be okay. And then if they experience loss later in their portfolio, so say like, their portfolio continues to grow year over year, and they experience the loss later, all right, and this blue line assumes that they're, that's kind of like our base norm. You can see the difference. If in year one, they experience a loss, okay, that portfolio, while it was designed to last them, 30 or 37 years, is now depleted down to 25. Okay, if that loss comes later, okay, it's not as impactful. Okay, if the loss comes earlier, very impactful. Okay, so the significant loss could create a serious timing gap in the portfolio. So we talked about what sequence of return risk is, why it's important for you to learn how to mitigate it. Also, looked over a visual on how this actually plays out in somebody's hold during retirement. How do you overcome this, right? If this is, losses are going to happen, okay? If you can get through your entire retirement and not have any sort of market volatility impact, not any sort of loss or economic issue, kudos to you. I've never heard of it. We've all experienced something happening in our lives that will force us to make some sort of adjustments to our portfolio. But it's how we learn to mitigate it, how we learn to deal with it, how we learn to get ahead of the game and plan for it. That is the key. So how we overcome this is in a few different ways. Okay, we got some tools in our tool belt here that we can use. Number one, simply diversifying your holdings across, say, like cash, real estate, maybe even stocks, bonds, and mutual funds. Okay, you can create some sort of, diversification across non-correlated asset classes. That is one way to hedge. Another way to hedge is actually adjusting your withdrawals. If you experience a loss early on in your portfolio hold, okay, don't withdraw as much from your portfolio. See if you can allow it to catch up in an upmarket year. Okay, that would mean that you have to deplete your lifestyle there. You could purchase an annuity, okay, an annuity contract that gave you guaranteed income later in your retirement years. You could use bond ladders to create some sort of cash leverage later on as well. Or you could just pile up some significant cash reserves that were just sitting on the sideline, completely liquid and accessible. That way, if you did experience a loss in your portfolio, and don't withdraw from it, okay? You can actually use your cash sitting on the sideline. Now, a lot of investors don't like doing that because, cash has been, a rather hot potato to be holding these last couple years, especially with inflation. I want to offer you a different asset class to take a look at that can help you hedge the sequence of return risk. And that is tapping into multiple levers that we saw there. One, diversification, adding in a note fund. Two, creating a cash flow that is liquid, okay, much like a bond ladder or an annuity. And investing in a note fund will help you create that cash buffer, okay, especially if you go in an investment with reliable cash flow and that has some sort of liquidation period to it, meaning that you can get at the cash, really quickly, or the principal really quickly should you need to get at it. Investing in note funds, okay, and they're not all alike, but can actually help you reduce withdrawals from volatile assets. Okay, so if you have an equity side of your portfolio, you've got it, and then a note side of your portfolio, the notes can provide that stabilized cash flow. Okay, and therefore help preserving any sort of drawdown on that equity side portfolio or the growth side of the portfolio, and can help you maintain your portfolio value, meaning that you're not going to be, you can tap into your note funds, okay, rather than having cash sitting on the sideline. Your cash is performing in a note fund, and then you can allow your growth assets to kind of weather out the market cycle. Therefore, you're not forced to sell assets in a down market, and you're not forced to introduce that sequence of return risk intentionally into your portfolio. And then again, a note fund can just be a great diversification play because it tends to be uncorrelated asset class. All right. So I want to just touch on how we do this here at passiveinvesting.com. Again, really it's understanding how note funds can be a tool to help you reduce sequence of return risk. But I would be remiss if I didn't actually show you our particular note fund so you could see how this might be levered into your own investment portfolio. In this particular case, in our note fund, we offer a preferred return depending on your investment level of 6 to 10%. As you can see here on the right, there's different investment levels. In our note fund, you're diversified across all the loans in the note fund. So about 1,500 notes, plus or minus in our note fund right now. And your position is secured by these note funds. Now, not all note funds are created equal. If you've watched my other YouTube videos on note funds, you can have notes can be really risky. You could do some really kind of crazy like mezzanine debt, construction debt. You can do some other things. I wouldn't say that are crazy, but more of a momentum type of investment rather than a conservative type of investment. For us, we invest in that first position lien loan on fix and flip real estate. And most importantly, our fund is unlevered. We don't take your money to go borrow additional money from the bank to create leverage in order to lend out. Okay. Your funds are typically invested in about a month. 3 to 4 weeks is our kind of running average there, which means you get invested very quickly into the note fund. And, we have a very low break even. So only 55% of the loans in our fund have to perform in order for the limited partner to get paid their returns. Okay. And we offer that short-term liquidity on the note funds, meaning if you did have to withdraw down your note position, you could do so. We have 90 days to get the money back to you, but we often get the money back sooner than that 90 days. Okay. And you can actually plan to take that as a monthly distribution. Your return is a monthly distribution, or I want to show you the magic of compounding here. So this is just one of the perks of the fund is that you can allow your return to continue to compound. So this is, I think, really greatly paired with SDIRA account, a self-directed IRA account, or a solo 401k. If you're not needing to take a distribution here soon, you could just allow your return to continue to compound month over month. And then in 10 years with compounding, your investment, say a $100,000 investment, actually has a 17% effective annualized return. Okay. Now, I wanted to give you an example here, okay, of specifically how a note fund, something like ours, note fund, could actually help reduce the sequence of return risk. And let's take our hypothetical investor, Susan, here. She's rolling into retirement with $2 million and needs $65,000 for basic living expenses. She finds a note fund, say like our note fund, she decides to invest $475K at 8%. Okay, just under that $500K amount. Now that will yield her $38K interest annually. Okay, now if she needs $65K in retirement to cover her living expenses and her lifestyle expenses, actually, that $38K goes a long ways because now she can, if she hits, any sort of volatility in the market, she only has to draw down her portfolio $27K a year as opposed to that entire $65K a year. And it's because Susan planned. All right, guys, I want to make sure we leave plenty of time today for our Ask Me Anything session, but when should you plan for the sequence of return risk? Again, I say now. You start planning for it now. So if you're in the accumulation phase of your portfolio, make sure that you understand this concept and build a foundation level of cash flow. Okay, maybe this cash flow helps feed an emergency fund, maybe helps plan, help you set aside money for planned expenses like cars and college, vacations, large vacations you want to take, but also for the unplanned expenses. And this foundation of cash flow can also pair very well with your emergency fund. If you're about 5 to 10 years away from retirement, make sure you're consciously starting to shift some of your equity investments into income producing investments like a real estate note fund. Okay, because this will help you build out your withdrawal strategy. And that way you have this cash flow coming in. It's already there in place as you're moving into retirement. That way you're not taking out large chunks of withdrawals in the first early years of being fully retired. And then throughout retirement, make sure that you are going back to your portfolio, that you're continuing to adjust your plan, maybe add to your cash flow basis, and just continue to monitor and adjust. All right, guys, if you're here live, we're about to move into our Ask Me Anything part of the show. But I want to leave you with a quick invitation to join me at passiveinvestingwithwhitney.com. There we can talk about your investing goals and how we can help here at passiveinvesting.com, as well as you can see our open deals. Guys, if you're here live, don't go anywhere. All right, guys. Sorry, it took me a moment to find that pause button. What questions do you have? Jump over to the chat box or the Q&A box. I'd love to help out. Was this, as always, I'd love to know, was this useful? Was there something, what did you love and what would you love to see? Okay. Question here is, oh, great question. With interest rates expected to drop later this year, will the note fund preferred return drop accordingly? Not necessarily. I can see how that would be a concern, but on single family fix and flip real estate, the interest rate on these type of loans tends to stay up like around 12 to 14%. We could expect with interest rates dropping, it's going to take a while for banks to kind of come back online to do this type of investing. So we're like a year or two out, I think, from seeing any sort of adjustment on the overall rate that the lenders charge. So with that, there's a nice healthy spread in there between what the rate that's being charged and then what the preferred return is. So I don't think you're going to see necessarily a drop in the preferred return. You might on the upper tiers, if you're like, say, have deployed $1 million in cash and you're getting a preferred tier of say like 10%, once you might see that type of return cycle out, but like for the 6 and 8% tiers, I don't see those preferred returns, adjusting at all. Okay, but I want people to understand that I don't think the interest rates are going to impact this type of lending, bridge type lending, as much as people think they do. There's always going to be banks. This is really an underserved part of the market. Are the returns you showed for the PIK note fund guaranteed or historical returns or projected returns? Okay, so it's the preferred return. That's what we're going to call it. So it is the hurdle. But it is, if you're seeing anybody say guaranteed returns in private equity real estate, that probably is a misnomer. The SEC won't allow anybody to say guaranteed returns. So there's something a little fishy going on there. But it is the preferred return. So if we are lending out, say at 12, 13, 14%, okay, there's also the origination fee, everything like that. That's on top of that, the servicing fee. That is all paid by the borrower. And then the limited partner is getting their preferred return. And then the split goes to pay for the expenses of the company, and any of our overhead, and then profit sharing after that. So it is the preferred return. It is, again, this is a debt fund, not an equity fund. So there's no real projection here. And then historically, we have always hit the prof. It's always been on a monthly basis. And we haven't missed a date. And like I said, mathematically, only 45% of our loans could default. And we could still hit the preferred return for our investors. Now, our default rate has been 0.2%. Okay, we've had 3 defaults to date, 3 defaults in 4 years over 1,550 loans. We target a 0% default rate. Our most note funds target a 1.5% to 2% default rate. So they're looking to kind of take bigger bets on positions and charge more interest rate. And if 1.5% to 2% default, they're okay with that. We are looking to make this a very sound, secure, conservative investment for our investors. Again, it's kind of one of those investments that helps you sleep well at night. I mean, I want my investments to be boring, quite honestly, with you. Oh, somebody said that information. Yeah, so somebody said like the spread there, makes it very lucrative for the fund manager. Yes, and think about it. All of the business expenses are being taken out. So if we charge, say, a 12% interest rate on the deal, okay, the borrower is like thankful for that because they can't get that type of lending for the purchase of an asset, the construction of an asset. They can't get that from the bank right now. And this has been a product that's been around for many years. I scaled my entire 36 single family rental portfolio off of a product just like this. And so I was glad to pay 12% for 6 months to have somebody else lend me the money so I could do more deals, right? That was an investor. That's how I scaled my portfolio. And I'm not going to hold that 12% forever. I'm only going to hold that note, that 12% loan for, say, 6 months. And then I'm going to go find other lending that's at 7%. And then I'm going to get my capital back. I'm going to go get another deal. And I'm going to do this all over again. Okay, so for me as the borrower, I love this. My lender can move super fast. We get to know each other. I can do deal after deal after deal after deal, and add those quickly to my portfolio. Okay. Now for the limited partner, this is amazing. You don't have to source your original notes. You don't have to go underwrite the borrower, the market, or the deal. You just have to underwrite the operator and understand what markets we're in and how we vet our borrowers. You don't have to figure out how to service each individual loan. And quite honestly, you're deploying capital and it's spread out over 1,500 loans, okay? As opposed to just one loan, right? You could place 100K over 1,500 loans as opposed to writing one single note for $1,000 or $100,000, right? So it gives you that diversification. So there's that return on time there. Now you, as the limited partner, get paid first. Okay, so you get paid first, and then all the business expenses come out, and then whatever's left over, the general partners, the operators of the fund do get to keep. So again, it's this is how passive investing works, right? I, as a limited partner, want my time back, and I want to leverage somebody else's expertise in business in order to get that time back. All right. After reaching the preferred return, are there any profit split between the LPs and the GPs? No, this is not an equity deal. This is a debt deal. So you are the bank. That's it. We are writing loans as the bank. We're writing the loan. Okay. So we aren't participating in the profit on, or the the appreciation on the asset. Okay. That is additional risk that we don't want to introduce into the portfolio. Again, in this particular note fund, we are investing in the bottom layer of the capital stack, the senior debt position. Okay. Lower risk, and, potentially a little bit lower return. Okay. If you want to be able to be in a equity position where you're splitting those equities with the common equity position with the general partners, you're now going to elevate yourself to the equity side of the deal. Okay. So higher in the capital stack, further away from the senior debt. Okay. But you potentially can get higher returns by, sharing the equity of the deal. Okay. This is the different type of investment asset. Again, we want this type of asset to be as boring as possible to provide that stabilized cash flow that just comes in like clockwork. Okay, this is your set it and forget it. Is the note fund audited? Yes. I don't know who audits that. I can get that information if you want to email me at whitney@passiveinvesting.com, but yes, it is audited. Do you know if there are real estate backed note funds which share the upside with LPs? Again, the note fund, if it's an honest to goodness note fund, then you aren't participating in equity, so there is no upside to share. There might be a note fund out there that is, if they hit a certain, profit for the year, they might give an extra percentage or two. I have seen that out there. Two things I caution you about. One, they're always levered. There's always a leverage component, which makes it way more risky. And then two, they're probably also investing in secondary notes or construction notes. That's how they're able to offer that a little bit additional profit sharing percentage, is that they're taking riskier note positions. Okay, so if you want a risky note position, go do it. Totally fine. If you are looking for an investment that is secured by first position lien notes and it has been paying out like clockwork, takes on zero leverage, it is conservative and plain vanilla as they get, let's talk. I would love to talk to you. You can, again, email me at whitney@passiveinvesting.com. Awesome. I saw a couple more come in the chat. Let's see. I think we've got all those questions answered. Guys, I can hang out here for a couple more minutes. If you have additional questions, please let me know. I can be about anything. Otherwise, I will be out next week at a conference, and Rob Gallo will be stepping in with his investor relations team. They'll be doing a coffee Q&A next week. Otherwise, thank you so much for spending your time, not only here for yourself, but here with me, investing in your knowledge. Yeah, as always, you guys are welcome. All right, any more questions? I'll hang out for one more minute, dump them in the Q&A box. All right, guys. Well, take care and we will see you soon.